Right, well, hello everyone. Welcome to FNA's first Treasury Broadcast. As you may know, we run 3 other broadcasts very similar to this one. We've been doing so for over a year. So we have a CBDC one, we have a SupTech one, and we also have an FMI focused one. So given the time that banks have had recently, it certainly made sense to introduce a liquidity Treasury focused one. So here we are. Thank you for joining. Pleased to see everything's working okay. We can see people joining. So whilst we wait for people to jump off Zooms or whatever it was that they were doing before, I'll just jump into some housekeeping, very quick intro to FNA, and then we'll begin. So typically we start, or we build these broadcasts fairly steadily. So we'll have some internal folk on, and then start to introduce guests later on in the episodes. But this time we've gone big from the start. So we've got 2 fantastic guests today from Deutsche Bank and from Lloyds. But as I said, let me just jump into some quick housekeeping and then we can get the session started. So I'm Anthony, I look after marketing here at FNA. This session follows a 60-minute format, of which roughly 45 minutes of that will be the discussion, followed by a short Q&A of 10-15 minutes at the end of it. So if you'd like to ask a question, which I would encourage you to do so, please do. Don't use the chat functionality at the bottom of your screen. It's likely to get lost in that. Please do use the Q&A widget at the bottom. And then at the end, our guests will aim to answer as many of them as we can at the end of the session. So next slide, please. Now, for those of you who perhaps aren't familiar with FNA, I'll just explain very quickly what it is that we do. So FNA is an advanced analytics and simulation technology company. We work across 4 core sectors, namely central banks, commercial banks, FMIs, and national security. And our software is solution-based per sector. So where a central bank might use our technology for RTGS stress testing purposes, a commercial bank will use the same underlying tech to optimize their liquidity. Which brings me very nicely onto the next slide, which digs a little further into our intelligent liquidity optimization solution, which we refer to at FNA as ILO. So ILO was built off the back of running analytics and simulations on critical payment systems and networks. So ILO optimizes liquidity in real time, and we do this by resequencing payments in an efficient manner using our own algorithms and technology. So importantly, this results in significantly less payment delays, lower liquidity buffers, and more importantly, lower liquidity costs for the banks using it. So we're implementing ILO with a number of GSIBs at the moment. Expect to hear more about their journeys using ILO in future episodes. So onto our discussion. I'm going to hand you over to Philip Strelli, who is the president here at FNA, who works very closely with our banking partners. Philip will introduce our wonderful speakers, and then we'll get the discussion kicked off. So Philip, over to you.
Thank you very much, Anthony, for the introduction, and welcome everyone, and thank you for joining as Anthony intimated our inaugural Treasury broadcast together with myself and 2 very experienced bank treasury leaders and liquidity managers, David Minch-Dixon from Deutsche Bank and Peter Left, who I'll introduce in a bit more detail in a moment. Today, we're going to be addressing challenges related to the recent banking market turmoil, which some would argue is still continuing if you picked up the newspapers here this morning, as well as related longer-standing, more strategic issues around treasury management. Together with today's guests, we will discuss how treasury management approaches have evolved in response to changing market dynamics, the effectiveness of treasury and liquidity risk mitigation strategies during past market events, the importance of fostering a risk-aware culture within organizations, the incorporation of innovation and technology into the picture, the role of scenario planning and stress testing, and our guests' outlooks also on future trends and developments in the industry. This Treasury series of broadcasts aims to provide valuable insights and lessons learned for bank treasurers, for liquidity managers, and other interested individuals in this space to allow for input into navigating risks and uncertainties in today's rapidly changing financial landscape. So I'd now like to just very briefly introduce David and Peter. So David is the global head of balance sheet management and liquidity management at Deutsche Bank. He's based in London. David oversees all of balance sheet and liquidity and funding strategy on a global basis. For David's sins, he also has responsibility for the funds transfer pricing process on a global basis, which would surely make him a very popular individual within Deutsche Bank. So thank you for joining, David.
Thank you, Philip.
And secondly, I'd like to introduce Peter Left. I think a great background and set of positions in Lloyds banking group for joining us on this first Treasury broadcast. So Peter has a couple of decades of trading and coal-face Treasury risk management experience. Until very recently, he had responsibility for all funding and liquidity management for Lloyds Bank here in the UK. He's recently moved into a new role, which I think is very interesting, which is a Lloyds group-wide role as head of digital and market innovation, where I think perhaps I'm correct in saying, Peter, that many of the things that you were doing as a moonlighter for the last few years around the innovation and tech agenda, you're now doing as a full-time job.
Yeah, indeed. Yeah, and thank goodness I'm not trying to moonlight now, given all the work that's been focused on liquidity management as we speak, and how well timed this session is, of course.
Excellent. So welcome to you both. And so let's jump right in. So I've obviously gone through the headlines of what your jobs are in a couple of bullet points, but it would be very useful, I think, for the attendees here to hear a bit more from you about the scope of your current responsibilities as individuals, as well as the overall approach and structure, including roles and responsibilities of Treasury management in your institution. So if we could first go to David, please.
Thanks, Philip. Yeah, so at Deutsche Bank, I think as is almost universally the case, although not quite, the Treasury function sits underneath the CFO function. We divide ourselves functionally into three main pillars. A markets execution function, which is responsible for our money market and pool trading and actually moving cash around the bank, issuance, and management of our discretionary liquidity reserve portfolios to try and optimize the yield on all of those. And they're also responsible for, let's call it, the strategic interest rate and FX positioning of the bank. They're relatively markets aligned, so they're the best placed people to do that. And so they sort of position and execute the sort of structural hedging programs for the bank. Then we've got a capital management function, which is responsible for steering our CET1 leverage and bail-in ratios. And then we've got balance sheet management writ large, which is responsible for the funding structure of the bank, the sort of steering us towards a relatively optimal NIM, day-to-day liquidity management and FTP. And it's that latter pillar that I'm responsible for. And the way that we came to the setup that I currently run was quite interesting. So the markets function and capital management function have been long-standing pillars of Treasury. And what we found was that we were constantly fighting fires on individual other items as they came along. LCR is introduced, you try and optimize LCR. And NSFR comes along, you try to optimize NSFR. Leverage is a problem in the sort of classic IFRS balance sheet sense, you try and optimize that. And eventually we got fed up with that and said, we got to do that on a consolidated basis, trying to optimize the efficient frontier across all of those things. And that's why we built up balance sheet management. And quickly, we realized that once you have view over all of those things, and in particular the liquidity modeling, the most natural thing in the world is to bring FTP into that so that your FTP is aligning to your attempts to optimize amongst all of those constraints.
Excellent. Thank you. Peter.
Yeah, so I don't cover quite the same breadth as David does here at Lloyds. So my previous role was focused on that funding and liquidity pillar within Treasury, and I had peers across market risk and across the capital pillar as well. But to many of David's points, it's absolutely paramount that those sort of pillars and that team has really close alignment and collaboration. Because you have to optimize across all of those pillars. But I think that probably the most energy that we put in, especially given my role with sort of the safe funding and liquidity, was my team was always the team that makes sure that there's good, robust challenge to the funding plan. So the slower engagement, and then there's faster engagement. So the sort of building the long-term operating plan, working with the divisions, thinking through, what's a resilient asset and liability, strategy for them, understanding their customers' needs, understanding how that's going to flow through in product design, how that's going to sort of iterate in terms of their balance sheet and funding needs, how that then interacts with, other customer segments, other sort of business divisions, so that we then bring all of that plan together. And of course, that's an iterative process to that optimization point. So we'd get something come down, okay, we sort of look at it, we test it. So big part of our role is to try and challenge the resiliency of what is being designed from sort of that customer first perspective, to then think, okay, let's put our treasury risk management hat on and sort of run that through that sort of optimization cycle, through that business plan back into the team. And obviously that's a long-term process, but then in parallel to that, the sort of the day-to-day short-term, which for the funding and liquidity team is, making sure the balance sheet always balances to all the required resources that we set ourselves, from, yes, the regulatory requirements, but I think more importantly, for all of us, that we have much higher board risk appetite and internal risk appetite requirements. And as you see, if you think about LCR, you can kind of tell from everyone's reported LCR that their binding constraint is something that's set internally, not anywhere near their LCR, given everyone is so far above 100%, for instance. So we've got that sort of long-term process. We engage in the short-term sort of day-to-day delivery. So having that more real-time information to sort of make sure that we're meeting all of those internal risk appetites. We would do that by being able to change the dial on short-term funding programs within the team. And obviously we would also then make sure we've delivered and invested a substantial portfolio of liquidity to cover, against those internal metrics, not just the regulatory metrics. So that's probably a reasonable summary, I hope.
Yeah, no, I think actually, and I think it's very good that both you and David, Peter, hit on a number of common topics, which I guess isn't a surprise. I think you both hit on the need, or I guess over the last 14, 15 years, obviously immediately post the global financial crisis, there was a lot of focus on what we might term whack-a-mole of NSFR comes up, new BCBS 248 standards come up, new IRBB standards come up, new LCR standards come up. They differ a lot by country in some cases, and the need to move away from that towards a more integrated model. Also, I think you both mentioned, in using different words, the need to move towards a more tightly integrated process where both liquidity risk management and broader balance sheet risk management, capital planning, collateral, et cetera, is very tightly integrated with the business through financial planning processes, through FTP, et cetera. I think, Peter, you mentioned tech enablement. I know that's something that's also very important at DB. And you both mentioned, again, in different words, the need to, really to look at internal bank idiosyncrasies rather than just regulatory requirements, and the fact that this is a continuous process. It's not a we solved it and done. And I think, as we get into some of the lessons learned from the last 6 or so weeks, I think that'll very much be borne out. So I think very, very, very good start to the session. I think I'd like to next go to, I guess directly to what's happened since early March with Silicon Valley Bank, Signature. We obviously saw news from First Republic last night and over the last few days, Credit Suisse, obviously, and what happened with them during March. And I think what I'd be interested to understand from both of you, and maybe this time Peter first, is what, if anything, surprised you about the recent banking sector events, and what do you see also as the emerging lessons learned? Peter.
Right, yes. So I think what surprised me is, well, I sit here in the UK with very much a UK European focus, so very familiar with the way regulation's been implemented here, and appreciate there is a differential implementation between sizes of banks to encourage competition, which I assume is a similar model as the US takes. But I was a little bit surprised to see a bank like SVB be so big before big chunks of the lessons learned since the global financial crisis, all of the sort of Basel III reforms that came in, were not requirements for them. They didn't have to, take to common equity the fair value losses on the US Treasury holdings that they held in their banking book. So for everyone in the UK and Europe, you might have in your liquid asset buffer, so similar kinds of assets, perhaps not, in the same way, let's say. But if you do, then you're going to see if that interest rate risk is unhedged, you're going to see that very quickly, because it will come through in your fair value for other comprehensive income, and that'll be reported in your CET1. It'll be very transparent. As I think what we've seen is that transparency is actually value add. It gives confidence, because now confidence can be eroded very quickly. The last global financial crisis, it was about, photos on the news bit of people queuing outside of the branches and things. And now it's near instantaneous with people messaging on Twitter or Reddit or whatever it might be. And there's certainly been analysis, since SVB sort of linking the speed of comms around social media and the rate at which that's exacerbated a bank run. So I was surprised that the transparency in quite a large bank wasn't quite there. And then that sort of brings me into some of the sort of the lessons learned thinking is transparency is key, because the whole system runs on confidence and trust. So it's really important that we're transparent. So there was the surprise that perhaps such a large entity hadn't gone and implemented some of those rules was an eye-opener.
Yeah, I think very good point. David.
Yeah, just to pick up on Peter's point around confidence. I mean, I think for me, an issue that I've been concerned about for some time prior to this is that we don't yet have a good regulatory structure, let alone an investor reaction or a counterparty reaction muscle memory around when it is that we start using the buffers that have been built up through all these regulatory changes, be they capital or liquidity. And I think one of the dangers that we see is that, all of this regulatory tightening just sets a new sort of level set expectation. And as soon as you have a dent to confidence, none of these static balance sheet ratios seem to do very much to reassure anybody. Credit Suisse failed with a 14% CET1 and a 145 LCR. And I think that, once you've lost confidence of your counterparties for whatever reason, none of these static measures of balance sheet strength seem to do very much to help you. Now, I think we'll talk a little later on. I think they are helpful in resolving the situation outside of a going concern scenario. So they're not worthless. But I think that the big lesson learned for us here is that, you know, countermeasure strength and the ability to maintain whatever level it is that you last put out in the market when you have these confidence shock is absolutely critical. And then, you know, on the surprise side, I mean, I think the pace of some of the deposit outflows that we've seen in a number of cases is definitely something we're going to need to spend some more time thinking about. I think SVBs are really interesting and one would hope unique case in just how concentrated and flight sensitive their depositor base happened to be ex ante, and also I think the scale of their deposit run up was highly linked to the interest rate environment that put them under pressure when that cycle turned. So, you know, you'd hope that there are reasons that it's an outlier on the top end, but I think you have to take seriously the possibility that deposit runs are going to look different in the future to, you know, to what we've all been used to looking at as the comparators in the past.
Excellent. I think all very good points. I mean, I would concur with those. I mean, you know, I think the points around different standards in the U.S., you know, which, you know, different standards from the outset and then further diluted during the Trump administration in the U.S., I think is something that has been very glaring. Your last point, David, around pace of deposit outflows. You know, we're a VC-backed company, and we happen to be one of the VCs that received messages on Thursday and Friday from our VCs telling us to get money out of SVB if we had balances there. And that was happening all over the US and all over the UK, kind of on that Thursday or Friday morning. So very real stuff. You know, and both of you again said in, you know, with slightly different terminology, you stressed, I think, Peter, you said transparency gives confidence. You know, David, right towards the end of your comments, you know, I liked your points around, you know, the fact that, you know, there needs to be clarity and consistency around the metrics. In some cases, there is still lack of clarity around the ability to draw down buffers, et cetera. And I think that's something that regulators should provide more transparency on themselves. So very good points, guys. Next, I'd like to, I mean, obviously the world changed tremendously after the 2008-2009 financial crisis from a lot of perspectives, but particularly from a regulatory perspective. David, you mentioned NSFR and LCR standards. You also mentioned IRBB standards and leverage standards. There obviously was also BCBS 248, which got implemented in different ways at different times in different jurisdictions around the world. What I'd be interested in is in your two organizations, I guess at the coalface, practically, how have your bank's liquidity and treasury risk strategies changed since the global financial crisis in a way that you believe put your banks in a better stead over the last 6 months or so? Perhaps first to you, David.
Sure. I mean, I think that the two fundamental transformations are one, obviously, like every other institution with any kind of material wholesale operations, the tenor of our funding and the liquidity of our balance sheet is dramatically different to where it was prior to the 2008 crisis. And so, you know, when you go through any particular period of market turmoil, the volume of liabilities you need to worry about addressing over any given month, quarter, what have you, is just on a different order of magnitude to where you were before, and represents a manageable fraction of your available liquidity reserves. Now, as I said, you don't want to actually draw down on those in almost all cases because of the confidence issues that we mentioned, but you know, you're dealing with a much more manageable balance sheet in any given period of stress as a result of those changes. And I don't think we should pretend that hasn't been though costly, a positive outcome of the regulatory changes that we've had. But the other thing that I think is actually more important is just the sea change investment in our data and capability and our ability to know where our position is on a given day. You know, when I started working in the sector, it was not uncommon for us to be wondering what our liquidity position was 6 weeks ago. And even then, we'd often have questions about how on earth did that movement make sense from the read that we had 10 weeks ago. You know, now, by and large, every day, I get to see a liquidity position that makes sense in light of its move from the prior day and is explained by proper drivers. And even more important, all of this knowledge is deeply distributed across the organization. So we can go and talk to the business lines that we have concerns about or we think may be able to help us, and they will know what to do to help us put us in the liquidity or balance sheet position that we want to be in. You know, there's been a lot of other changes around, you know, testing out asset monetization and making sure we've got, you know, new levers to pull that maybe we didn't have before. But really, those two are the fundamental changes since 2008 for me.
Yeah, good stuff. Peter, anything to add?
Yeah, well, I mean, that's pretty comprehensive response, but there's a couple of things that I'd like to sort of add to the equation. And I think, you know, some of it's a bit more cultural since the global financial crisis. And we're sort of within that culture, I think, is a really good transparent relationship with the regulator. And I think that, combined with obviously now significant bail-inable resources, MREL, TLAC, etc. You know, we now have you know, central banks able to have much more confidence to provide liquidity facilities because there's now much bigger buffers. So, you know, we've got things in the UK, Europe, the US, and to sort of David's last point, hopefully those facilities are all being tested, right? And it's not you know, oh, we've got to get the playbook out of somewhere because we've forgotten how to use that thing. It's like the conversation's continuous, the challenge is continuous, the readiness to use those facilities is always there. It's not a reactionary process. So, you know, hopefully that sort of cultural mindset change has been a real powerful change, sort of in addition to sort of the fundamental reg changes. And you know, I do want to build on that data accessibility point that David was making. It is, you know, I came from a trading role into Treasury, so I was used to having like real-time market risk and these sort of things and streaming prices. That was my mentality. And then sort of coming in from a trading book perspective into a banking book, you know, was slightly underwhelming in the very first days around the speed of reporting and the availability of data. You know, but now, yeah, I'm really pleased. Look, there's still work to do, but now we have that sort of, you know, we know, just like you know your market risk at the end of the day. You know, I know my LCR and other, you know, risk metrics at the end of the day. And we can do things like, you know, flash versus actual and these sorts of things, and explains on a daily basis. So we, you know, starting to have the capability sort of nearer real time to understand if a problem's evolving, and you know, that's really exciting. The sort of the effort everyone's put into data accessibility to sort of improve the, you know, the resiliency of the system. But, you know, as I'm sure you'd expect me to say, given my new role, there's as much journey to go still.
Yes, you should have a job for a while, Peter, I think. Good job security. Yeah. But yeah, and I would definitely echo your point around technology. I mean, I've been working with commercial banks for nearly 3 decades in the capital and liquidity space, but F&A, we've really only been working, you know, our pedigree was in market infrastructures and central banks. We really only started working, you know, in bank liquidity management over the last 3 years. And where many of the banks were even 3 years ago, and they are now in terms of data visibility and real-time treasury capability is it's been a step change just in the last 3 years. So I think very, very good point. One of the key debates over the last 6 or 7 weeks, I mean, you could pick up probably almost any serious paper on any day over the last 6 weeks. And, one of the key questions being raised is, how has regulation failed, or in what ways, or has it failed? I'd be interested in your views on, do you believe regulations failed? And obviously you need to be a little bit, as a regulated institution, a little bit careful around that, even though we're under Chatham House rule here. But what are your views on the likely regulatory changes that are going to result from recent market events? Maybe Peter?
Yeah, happy to. As you say, I don't really think that it's regulation that's failed. I think, and that's borne out by the fact that I would probably argue, that things are relatively contained, and it was sort of idiosyncratic, and unfortunately the failure was, one or two institutions rather than the regulation of the whole system. So I don't think I would phrase it as regulation failure. But I did sort of mention earlier the sort of differences between regulation at the smaller end versus the bigger end earlier. And, I think the system, we definitely want competition. So I can understand why you would you'd want that. So that's not necessarily a problem, but maybe we need another framework to make sure that there's a safety net so that you can facilitate that competition. So I think you've seen sort of short-term reactions of an increase in deposit insurance, for instance. And I think I'm right in saying Mr. Bailey has been speaking over in Washington a couple of weeks ago, I think, representing the Bank of England's view in thinking about, do we need to increase deposit insurance so that we can have a slightly tiered regulatory regime to have smaller banks be able to compete and sort of compete in credit creation and innovation in payment services, etc., and have better customer outcomes. Keep organisations like mine on their toes, etc., and provide me with the job to facilitate the innovation and make all of that great change happen. But so I don't think regulations failed, because I think the rest of the system is very resilient. So it was individual issues, I feel. How might there be some reaction to this? I think we probably still want to have a framework that can facilitate competition. So it's learning what was, in the SVB example, what was, what things should we have asked for that we weren't, and where we do allow sort of differences, maybe there's there's things like increased deposit insurance that can help minimize the risk where you are trying to encourage competition, let's say.
Okay. Views, David?
Yeah, I broadly agree with Peter, actually, that I don't think regulation's been proven to have failed. I mean, I think that, interestingly, the weakening of regulation that SVB benefited from just a couple of years ago has proved to have been short-sighted in remarkably short order. Although one of the things it was exempted from was the LCR, which I think would have looked very strong, even had they had to report it, because of the shape of their balance sheet, and they had really a failure of asset monetization, not a failure of liquid assets, and a failure to keep enough of their liquidity buffer in readily available cash. I think Credit Suisse is a fascinating example as well, right? I mean, they obviously the regulation didn't prevent them from running into sufficient trouble to fail as a standalone institution despite their strong regulatory ratios. But on the other hand, they came pretty close to arranging a private sector solution to the problem through better starting capitalization and the ability to bail in the AT1s. You know, there is some government guarantee there, and we've yet to see how it really shakes out. But I think if you'd started with a pre-GFC balance sheet on an institution like that, there's no way you'd have avoided an enormous amount of public money. And we saw that in SVB, right, which is subject to no bail-in and much weaker capital standards. So I think we're a long way from, I think, and it may never be possible, a regulatory regime that, you know, makes the default expectation that you'll be resolved as a going concern institution. But I think certainly if the goal was to remove as much implied subsidy at the point of failure, you know, from the institutions before they go under, I think Credit Suisse makes it look like that's broadly succeeded. My main concern is that, you know, the regulators will focus too narrowly on tweaking individual parameters on individual regulations for specific circumstances in this crisis that happens to, you know, underperform the implied model, and not really focus on the fact that, you know, your regulations should drive structural change, like the way LCR has just made short-term wholesale funding basically unviable. And I think that was, you know, largely a good thing if you're not funding liquid assets, and needs to leave your banking sector with sustainable profits that make it look resilient to idiosyncratic shocks, because that's ultimately the situation that CS was in, right? Their business model had taken enough hits that there was no confidence that the next shock wouldn't be the thing that brought it down. And I think if regulators aren't sufficiently mindful of building a sustainably profitable sector, they risk tweaking the standards in ways that ultimately serve to weaken the banks, not strengthen them.
Yeah, if I can come in there, I think that, you know, the lesson learned for all of us, rather than a sort of change in regulation when it comes to CS, is that I think the example there is that when we're working on our recovery plans, we need to, you know, we need to know the speed at which we can deliver those recovery plans. And I think ultimately, the progress and the pace of action to improve the profitability of CS, take those recovery actions, people ran out of patience. You know, I think that's the example perhaps for all of us to take away is sort of really effectively test in its best way possible those recovery actions, and make sure that you can deliver them in a sufficiently timely in a sufficiently short time frame, so that you don't start to lose that confidence.
Excellent. All excellent points. And thank you to attendees. I see quite a lot of questions streaming in already, so pretty soon we'll cut over to attendees' questions as well. I guess continuing on the theme of regulation, and I'd ask this, you know, given your your very global profile, David. I don't know, Deutsche is operating in what, 40 or so countries, and has material operations probably in 12 to 15. Given that liquidity and treasury risk regulatory standards differ quite a lot in between many of the countries that you operate in, what do you find for Deutsche Bank are the primary challenges of operating a global business and including a global funding model across so many different regulatory environments?
Yeah, so yes, it's quite interesting. The sort of number of regulatory regimes that we operate under and the differences between the standards imposes what I'd call a cost of doing business headache that ideally we would operate without. But really it's a pretty surmountable one, right? It's a number of additional calculations. Sometimes it forces you to hold slightly higher liquidity than the global standard. Sometimes maybe you maintain a local buffer on top of your global buffer. But those, I'd say, are pretty, pedestrian costs of doing business in multiple locations. The thing that we're constantly on the alert for, and actually spend quite a lot of time actively encouraging our regulators to consider as an issue and to sort of lean against, is the local regulators' tendency to want to balkanize liquidity, balkanize financial resources, and impede the free movement of our liquidity reserves to where they're most needed. And I think especially when you operate a largely branch-based model like Deutsche Bank rather than a subsidiarized model, there's an enormous amount of strength in that, in the sense that you often encounter shocks which have very differential impacts in one sector or one country or one product type, whereas you hold liquidity reserves that essentially don't recognize that diversification. So if you can move resources around relatively unimpeded, your ability to respond to those shocks is much, much greater, and is to the benefit of the individual supervisors in the jurisdictions experiencing an issue. And so we found that actually after an initial period of balkanization, we're now getting more trust between the regulators and also more trust with ourselves that's what we're doing, and that we're not privileging one jurisdiction over another because they're shouting louder. And I think that the sort of data point that I made before that is fundamental to building that trust, right? Being able to show the regulators in real time, all the time, and in ways that make sense to them, why our reserves are where they are, and why when we make a decision to move them, that's a good risk-based decision and not a privilege of one jurisdiction over another. That allows us to benefit from that fungible funding model and lean against that tendency to want to balkanize, especially in a crisis.
Excellent. I'd like to put a separate question then. Thanks very much, David. I'd like to put a separate question to Peter. I think particularly given your relatively unique vantage point of having had a trading and treasury career for a couple of decades, and then having moved into the tech and innovation space, but much of that tech and innovation is still around, I guess, your old areas of operations. What do you view as the key areas of contribution for new and emerging technologies? Whether those are technologies that would be used within Lloyds or another bank itself, or technologies that are technologies that are creating kind of ecosystem-based innovation around new market infrastructures, new networks, et cetera.
Oh gosh, that was quite a significant question. You might have to come in and remind me of certain key parts as we go through. So I think application of tech in sort of risk management in treasury. I made the comment earlier about sort of social media feeds, sort of inspiring runs. I'd encourage everyone to think about sort of updating their EWIs, perhaps to use sort of certain technology feeds as sort of trends on social media to give early warning indicators. But probably an early warning indicator, way before that is thinking, about perhaps historic metrics were sort of, okay, you've reviewed business behavior and you see certain things, certain movements in different business lines, and you'll calibrate a sort of a trigger to go, oh, we've seen deposits move in this, part of the business by X amount. What's going on? We should go and investigate, and that might be some sort of early warning indicator. But I think with technology, you can make that process smarter and more dynamic. If you can start to use machine learning technologies on to forecast the behavior of those deposit products or those loan products and those off-balance sheet products, and start to see earlier any changes in customer behavior. So if certain factors in the model start to evolve and your forecast accuracy starts to deteriorate, those sorts of things could be even better early warning indicators of trouble ahead, and catch you even earlier before you start to see the deposit outflow. So I think the more we can sort of not just leverage access to real-time data, which has probably been the journey of recent history, I think the next period is unlocking access to all the historic data to help us understand and sort of calibrate models, and not just sort of models for individual product items, but the sort of coherent ones that, because when one deposit goes up, another deposit probably went down, or it could be on the asset side of the balance sheet that inspired the change. So forecasting in a sort of silo is not helpful. But if you can start unlocking historic data, unlocking that capability to forecast, see confidence intervals, see how forecast behavior is starting to change. So as your learned model starts to say, oh, I'm learning something new here, as soon as you start seeing a new parameter, that should be a chance to question what's going on. And hopefully that way, it's less of a reactive early warning indicator and more of a proactive. And so that excites me quite a lot, sort of unlocking machine learning to sort of, and unlocking your historic data, not just your real-time data. In terms of risk management as well, I'd say a useful area of technology, because sometimes data is not the best and as easy to turn into structured data as you'd like, is sort of artificial intelligence to help us turn old contracts into a structured form of data, because then that gives us the chance to do some of those exciting treasury optimizations, be able to facilitate more dynamic securitization activity and these sorts of things, and be more efficient with the capital management part of the pillar of the treasury function, for instance. If we can unlock access to more structured data from sort of historic contracts that might not be going through all the new plumbed systems and things like this. So sort of new feeds from sort of external technologies, application of machine learning to forecasting, but then not just forecasting individual line items, having a sort of a network, so that these deposits are forecast in relationship to those and to these assets. It's respecting the fact that credit creation is driven, like deposits are created because customers are lent money by banks. That's credit creation. And so when loans grow, deposits will grow, for instance, and if loans don't grow, deposits won't grow. So you do need that sort of coherence in your forecasting. So it's not just machine learning on individual entries, it's machine learning on as wide a system as possible. And then I think artificial intelligence to help us create structured data, to get us that legacy data that we still need to work with, get it in a more structured format. That's very helpful. That's sort of the three big ones in sort of treasury, and I think you alluded to sort of technology and improving some of the financial market infrastructure as well. Because I think one of the things in treasury and what sort of inspired me more recently is we cause ourselves some liquidity problems in the banking system by virtue of the fact we've sort of batch up processes to remove credit risk, for instance. So we collect all these payments together, batch them up into a single settlement event. That creates quite a lot of payment liquidity demand, because you've got some time critical payment now, which is in a very significant amount. But really, before it was all batched up, it was just thousands, tens of thousands of individual payments of very small amounts. And if they'd been allowed to flow in near a real time and just happen continuously, that would be much nicer from a from a liquidity management perspective. You'd have a much smoother profile of inflows and outflows. So I think if we can apply technology to reduce the credit risk, so rather than batching up stuff to reduce credit risk, if we can use technology to reduce credit risk, then we can reduce those time critical payments, for instance. And that's why I like the idea of smart contract technology applied to financial market infrastructure, either in the form of DLT or hybrid versions of that. You don't have to go distributed to unlock smart work flows, but I think so that we don't have to create follow-on problems like that sort of liquidity problem I was crudely articulating. That I think is quite exciting.
Yeah. No, I think all excellent points, Peter. And I actually would have a number of follow-up questions on some of the newer venues and networks that we see out there. I mean, there's a whole range of them, from Ripple to Finality to RTGS Global to RLN, which I know you're involved in, to Partior to Fintium. All of which have kind of different roles to play. Have frankly, they're solving for many of the same things, but trying to do it in different ways. I think they're going to be not too many winners, but I think I would love maybe in another discussion to kind of dive into that. I'd like to kind of keep to our promise to keep the last section to participant and audience Q&A, and we actually have a lot of questions, including some quite good ones here. And I think I'm going to go to maybe the most sensitive one first, and point this towards David, since it's within, to start with, at least, since it's within your direct area of responsibility. How do you believe your organization has integrated FTP, and do you think it's currently effective in aligning risks, costs, and returns between Treasury and other business units?
So I think we've taken a very good first step, which is that we kind of big bang overhauled our FTP framework to be liquidity led. So obviously there's a maturity transformation piece that's aligned to our ALM, but then in terms of the liquidity premia or the term premia that we charge or collect or pay to the businesses, that's fully aligned to our liquidity models, including the stress testing model. So every unit of term funding or liquidity reserve in the bank is charged out to somebody.
Yeah.
So that's the good. The bad, I'd say, is that there's always a bifurcation between proper trade-driven liquidity reserves and the sort of overall taxes, right? So the desire to hold a buffer above 100, the treasury activities that are costs that are broadly socialized, and most critically for me, the fact that if you want a completely consistent framework, you have to pick one metric, which we have, and allocate everything based on that. But then inevitably you find that today LCR is my constraint, not my internal stress, or tomorrow it's NSFR. But you don't want to be flip-flopping your FTP all of the time on those. And so I think you have to marry that with an amount of portfolio level steering that keeps the shape of your constraints in a place where, roughly speaking, your FTP is coherent, even if it's not perfect down to the last, billion of your liquidity buffer. And then every so often you realize that this pricing is just leading to a different constraint consistently becoming the binding one because you're underpricing it, and then you've got to make a change. And I think dealing with that periodic change in what your binding constraint is, and when you decide to reflect a different constraint as the marginal cost of your liquidity, is something that we still need to do some work on.
Right. Peter, do you have things to add on that point from a Lloyds perspective?
No, I mean, it's very similar story. It's as you want to get FTP as close as possible. I think it's important to be consistent with the business as well, because they're pricing customer business here. So you can't have FTP that's super volatile because you jump from one efficient frontier point to another. So I think you have to overlay FTP as your sort of crude tool with that continuous dialogue. It needs to be a grown-up conversation. It kind of needs to be, you've got to have the right culture in the organization as much as a robust transfer pricing approach.
Okay. And another question from an anonymous attendee. What steps does your bank take to monitor and manage counterparty risk during periods like we've seen of market turbulence? And how does this fit into your overall liquidity management framework? I'll leave it to either one of you to take it first.
Okay, so let's try. Always harder when you haven't pre-rehearsed for the live questions. So yeah, we have credit reporting available, sort of counterparty risk reporting available to all of our traders. So we know what repo capacity, for instance, we might have, and we think about having limits available in BAU, and then having potentially limits in reserve, because obviously collateralization might be we might still be waiting for that, for instance. And you might for instance think about entities like the CCPs asking for more initial margin, so you need to try and sort of forecast in how much you might need to use in terms of some of those products in BAU, and have appropriate limits for that, and then forecast how you might need to use those products in a stress, and see have you got enough limits for that, and is that realistic, that level of use, and if you were in that stress, what might be the over collateralization requirements that you might need to consider. And so it's taking really seriously running through your contingency playbooks for these different events, and really kicking the tires in detail, and making sure you've got a limit framework that allows you to engage with your plans in your playbook, and that you've got the liquidity plans to facilitate accessing that market if the CCP rules change, for instance. So I think hopefully it was a few things there. Sorry, I kind of focused in on the repo product, but I think it kind of brought some of the points to life there a little bit.
Yeah. I mean, I'll just echo what Peter said, right, which I think most of the work is done in BAU, setting up your tolerances and thresholds, and then making sure that any contingent action you've got in your playbook, you believe to be realistically deliverable even under a stress, and won't leave you with a concentration that you would, that you would wish to avoid if you weren't under stress. And so,
Yeah.
I can't think of a time when we've had to, on the fly, change sort of liquidity management action, or not take one that we would otherwise have wanted to for a concentration reason, because I think a lot of that framework is set up as part of the BAU.
Yeah. Great stuff, guys. I had a closing question, but actually I've got a very good closing question from the audience, so I'll choose that one. However, it's quite a mouthful. It's in fact 3 questions. So I'll ask, given that we just have a couple of minutes left, I'll ask you guys maybe to keep it to a minute or so in your response, which may be difficult. This is from Peter Dickinson from Goldman Sachs. How important is intraday liquidity for your banks in relation to other liquidity and balance sheet management issues? What is your long-term vision for managing intraday liquidity? And what is inhibiting you from achieving that vision? Maybe it may be difficult to answer in a minute.
Yeah.
I'll give you 2 minutes each, but
let's go. So let's crudely split up Lloyds Banking Group into 2 banks. We've got a ring-fence bank that does sort of retail and commercial lending and deposit taking. Peter, you can guess that probably is all about Pillar 1 liquidity and not so much about intraday liquidity. And then we have an investment bank operation, Lloyds Bank Corporate Markets, if you like, and that's not really so much about the deposit and lending activity. And there the focus is much more on intraday liquidity rather than Pillar 1 liquidity. I think funds transfer pricing, therefore needs to think about the two kinds of reasons for incurring a cost of funding, and that means that if we've got in your kind of investment banking operation, you might have FTP for Pillar 1 and FTP for intraday, and if there is something inhibiting you, it's being able to do the explain because you don't necessarily have access to the data.
Yeah, David.
Yeah, so I mean, I'd say materiality is very high. So, in aggregate across all the various components, intraday liquidity reserves are a material portion of our overall liquidity needs. So from a materiality standpoint, it is very important to us. And for me, the state that we've reached, I think, is a good understanding of the drivers of our intraday liquidity needs at a firm level. And where we want to get to next is disaggregate that down to the product and ultimately the counterparty level. Yeah. And then get to the point where we're not just optimizing that, but where it's part of the product suite that we're offering our clients. Yeah. Do you want a payments profile that's more intraday liquidity consumptive? Well, let's talk about pricing on that. Are you willing to work with us to optimize your flows? Well, maybe that's something of value to us that we'll be able to rebate to you. And so turning it away from just a dead weight that we need to carry as a cost of doing business and into something that is an active part of our product offering, that's the nirvana to me. And then, as Peter says, the barriers to that are data and analytics, but also, then we're talking about not a treasury standalone activity, but getting our systems and platforms to the place where, the settlement engines and the front office, booking systems are integrated into the way that we measure and calculate liquidity buffers in a way that means that when we achieve the correct change in Deutsche and customer behavior, that will lead to lower liquidity reserves and allow us to monetize that difference.
Excellent. Yeah, I think comments from both of you there were a great way to close it, kind of bringing it back to the business. We're seeing with many of the GSIB and DSIB banks around the world, the desire to bring it back to, can we influence the customer behavior of particularly our corporate, institutional, and global markets clients, in a way that aligns with the bank's interests so that some of the benefit can be shared. So I think that's a great way to close things off. Thank you, Peter. Thank you, David, for joining us today. I thought we had a great discussion. I'm not going to belabor the kind of closing message, but our team has included contacts for Peter, David, myself, number of papers in the chat. I think you guys would have picked up throughout the session. And we have here at the bottom of the slide that you see in front of you some of the upcoming broadcast guests, these being all in May in other broadcasts. So GMD, Bank of England, BIS, several central banks. So thank you also to the participants for joining this session. And we're looking forward to this being a growing treasury and liquidity community.
Thanks very much. Bye-bye.
Thanks, guys. Bye-bye.